This is Jay Martin.
David, it's great to meet you. Thanks so much for coming out today.
My pleasure. Thank you.
I've wanted to have you on the podcast for a long time, so this is a treat to get to do this live in front of the audience. Quick highlight, as I said, 30 years in the industry, coordinated over $10 billion in financings for the mining sector. You've seen good markets, you've seen bad markets, you've done well through both. Right now, given your record, your resume, and your experience, what's catching your eye? What are you paying attention to right now in the resource sector?
I think you probably hear it as a common theme. Obviously, gold and precious metals, strong, and we're seeing good prices looking forward. And then copper. And then behind the scenes, you've got uranium. It's coming up. I mean, you're changing uranium over the power plants you're seeing in the UK, which I'm from, 8 new power plants, nuclear power plants going in the next 20 years in the UK, and that's global. So, now precious metals, copper, nickel obviously is doing well, but really, my view long-term, it's uranium.
It's uranium. Okay,
Yep.
Interesting. So you just listed gold, silver, copper, nickel, and uranium, things you're paying attention to. For context, could you give us an idea of what Endeavour Financial does, just for the audience, please?
Yeah, so the business has been around 30 years, and the key part to our business is arranging finance for developing and new projects. So take an example. Recently, we just arranged the financing for Horizonte Minerals. It's a nickel project in Brazil, and it's about a $600 million financing to put that mine into development and obviously production in a couple of years. So that's the mainstay of our business.
Okay, now, what caught my eye recently was you made I don't want to say a shift, but you became the chairman of a royalty company, right? Now, whenever I see somebody who's got a track record like yourself make a move like this, I'm obviously curious as to why. What you saw in the market, this was maybe a year and a half ago, right? So a year and a half ago, you had a vision for a royalty company. So why then, right? Why now? And why did you make this decision?
Yeah, so, we're in the marketplace. We look at financing structures, we look at potential, who's going to provide the finance for the businesses, and mining obviously is our business. And we saw probably 5 to 6 years ago that the major streaming companies were getting too big. They now do 100+ million ticket sizes. There's no one doing the more smaller royalties, smaller streams, and also people are quite risk averse. They're not looking at countries that we know. We're a global business. We work all through Africa, through other parts of the world. And in reality, most of the companies are quite risk averse in the streaming business. So we got involved with Empress, and we're one of the founding partners of Empress, to look at doing smaller streams in more exotic locations, where we feel there's huge returns. And obviously we know the risk in those countries, we know the risks in mining, and we're happy to manage that on behalf of the company.
So you said there was a hole in the industry. You talked about the $100 million ticket size. Can you define that for us, please?
Yeah, the hole is the fact that the streaming company's done really well. They've grown, they've got a lot of capital, and they're able to put that capital to work fairly cheaply. But $100 million ticket sizes, you're missing out on a whole junior market space. The 30 million, smaller companies looking to put something in production. And they find it hard to get capital. There's equity markets, but they're open and shut depending on where the world is. So streaming is a great filler. Fills a bit of equity, is quicker than debt in most cases. And that was the space we saw, really, a small streaming company looking to put money to work for the smaller mining companies, where the larger streamers don't want to go or don't have the capacity because they prefer to do $100 million than 20 million, for example.
Now, I feel like there's been a surge of royalty and streaming companies since you guys went public. Has the original mission changed with Empress now that there's so many more competitors in the field?
It hasn't, to be honest, and as you can imagine, there are, as you say, a lot of people thought about the same idea, had the same concept, so I suppose that's great. That means it's a good concept. The difference between us is we don't buy royalties or streams from other companies or other people. We create them. So we're very much, as you heard by the introduction of Endeavour Financial, we're in the business place, we create solutions, we finance companies. So we brought the same concept to Empress. With Empress, we're looking to create, so it's direct negotiation with the mining companies, getting a deal, which then we can paper and obviously form a stream or royalty. So it's creating them, not trading paper, which a lot of other companies are doing. So we're never going to be a 200 royalty streaming type company. We're going to be more boutique-y. We're going to be more structured in what we're doing. And as a result of that, we're able to, in my personal view, and hopefully the results will show, get a better return for the shareholders. And that's the key part of what we're doing here.
That's the key part. Okay, now, I wanted to have this conversation in the context of the inflationary environment, right? So the reason I look towards royalty and streaming companies is for the fixed cost model, right? There can be some protection there, right? How typically, in your experience, do royalty and streaming companies function and perform in an inflationary environment?
Well, let's look at the basics, if you don't mind. I mean, inflation now, there's two types of inflation that I see in the marketplace. There's the CPI, and you've obviously got different countries, got different inflation, obviously US, Canada, Europe, high inflation. That's what you see in the newspapers. So the 8% inflation, the Fed said it's, short term. They got that wrong. It's long-term inflation. I don't know about everybody else, but I've seen inflation for the last 5 years. My bills have been going up. It's always been here, but it's only really just come through the system. And the key determinant of inflation, when you look at the breakdown, is energy, number one, and second is rent and food. Well, I don't see rents going down. When you look at how the CPI is calculated, I don't see energy costs going down. So I see that staying high because of obviously the Ukraine-Russia tragedy. And obviously, food, Ukraine, a major producer. So you see food costs going up. So I see the inflation in that sense staying high from that point of view. And then we have something which is important to the mining companies and our industry is the costs of doing business, the operating cost of a mine. So what I'm seeing throughout the industry and talking to our clients and talking to the industry is increasing operating costs for lots of factors. And it's mainly, it's just hiring people, the cost of staff, the cost of doing business, freight. Obviously diesel costs are high because of, the oil price. So you're getting a lot of inflation throughout the business. And whilst it's okay when prices are going up, because your margins are still fairly fat, that's a risk in the mining game, because what happens when prices fall? And we've seen some uncertainty in the last couple of months on prices. So it's all about margins. All businesses are margins. So, revenue-wise, cost-wise, what is your margin? At the moment, they're fine, but they're getting squeezed. Royalty companies, fixed cost. Empress is $1 million to run that business.
Okay.
That's it. So we get $5 million coming in this year, which is our forecast. We've hopefully got $9 million next year, $12 million thereafter, $28 million coming in the next 3 years. That's versus our $3 million costs. And that's mainly staff and a bit of M&A and a bit of marketing. So fixed cost, good margins. Unlike, sadly, mining companies, of which I'm a director of a couple, so I don't want to belittle them, but they've got to start cutting their costs, because inflation's here to stay.
That's right. Now, you've financed companies all over the world, variety of stages, some of the biggest mining companies on the planet, actually. I feel like the game is a bit riskier today, meaning there's more reasons to say no to a company than there used to be, right? Maybe it's runaway costs, maybe it's geopolitical risk. Do you see that to be the case?
Yeah, of course. I mean, I'm an investor myself. I look at the marketplace. I look at the different investments. The one thing about mining, and as you rightly said, I've been in the business a while, is it's cyclical. So you've got to pick the right companies, the one that are going to survive and ride that wave. And yes, of course, capital costs are going up, operating costs are going up, there's inflation in the system, but it doesn't mean a good company doesn't make money. Doesn't mean that company won't make cash flow and pay dividends and obviously return value to shareholders. So yes, I agree it's harder. And in the mining space in the last 15 years, the generalists have, after the last big mining crash, they've left the building. And we were just getting them back in the marketplace about a year ago when they saw the fat margins coming through, the revenue growing. And now with the capex blowouts we're seeing, increased inflation, uncertainty of recession coming back into the discussion in the next couple of years, it's tough. It's not going to get the generalists involved. And that's been the biggest problem in the last 10 years.
Right, and I would think, what's going to bring them back? Well, let me ask you this question. What's going to bring them back? Because you're right, they come at the end of the party, and they're the first to leave, typically, right? In any market, not only resources.
And I've been saying this for the last good number of years, we have to become dividend paying. The mining companies have to pay good dividends, regular dividends, and become a yielding asset class. We've got to change it from, we're growth, we're going to expand, we're keeping our money for new projects. Of course you've got to do that. But we have to start paying dividends and make mining a valuable asset class where you get a yield, rather than just getting capital appreciation.
Interesting. Okay, and so any jurisdictions that you'd caution investors right now, just giving global uncertainty, to stay away from? Do you factor that into your decision process, and how much?
Yeah, we do. So, as I said, we're a global business. We've done lots of deals in Africa, the Stans, even Russia historically, and obviously North and South America. So we're fairly comfortable with lots of countries. We take more of a long-term macro view. So from an investor point of view, looking at a country, how important is mining to that country? That'd be my number one check. So people talk about Peru and the issues potentially there, but mining is a huge business for Peru. Employs a lot of people, makes a lot of GDP, makes a lot of revenue. So you may get people going, we don't like mining, and politically, but in reality, they cannot stop mining. It just will destroy their economy, destroy jobs, and obviously affect them significantly. So unless you get a major reaction, a bit like a Venezuela, which is very unlikely, we feel that from an investor point of view and ourselves, we've often worked in those countries, so we know the dynamics, we know what's happening, so that gives us a comfort. But on the other side, it's really how important is mining to that country. And if it's important and it's a big GDP, then the governments usually protect that business.
Usually protect, and if they don't, typically the population speaks up. That's a good way to look at it, because often we get tied up in like recent election headlines, right? And we revalue our portfolio based on that. And Peru is a great example, because this just happened last year. And
and Jay, for example, we invested in Peru in the midst of that election.
Okay.
And obviously there was a lot of press about the president's nationalization, and but we looked at it, and we've all been to Peru. We know the people. It's such a big part of their economy.
So what would you have to say then? Because that's really important. I'd love to dig into that a little bit. There was so much apprehension about Peru a year ago. You were writing checks. So talk to me a bit more about that. What did you see, or what were you able to just discount in terms of news flow to have the confidence and conviction to keep allocating cash when everybody else was running away?
I think the key thing, as I say, is how important is it for the country? And secondly, electioneering. Well, come on. It's half of it is just made up to get the votes. The other half is the press saying what they want to say. So you just got to cut through that, and we have good contacts in the country. So we were talking to the people in the political and the economy, who are involved in that part of the government, and asking them what their view was. So really cutting past the hype, cutting past what's in the newspapers, and really getting to the source. And to be honest, 25 years in the business. South America, it goes up, it goes down, they write off their debts, they recover, like Argentina. We've seen it before. So you just have to have a good asset and ride it out. And if you look at, and I was listening to the earlier presentation when they said some of the successful entrepreneurs in the business, they pick up assets, they hang on to them, they wait till governments improve, they wait till financing is available, and then they develop them. And that's just patience.
That's just patience. They have the option to just sit and wait.
Yep.
It's a valuable option to have. Now, my first question for you is, after 30 years in the business, what's catching your eye right now? The first thing you said was gold. So let me dive into that a little bit. Talk to me about your time horizon and forecast for gold.
So, it's the obvious everybody comes up with gold is, at times of uncertainty, you need gold in your portfolio. And that's fundamentally one of the rationale from my side. Gold should always be in a portfolio. There's always uncertainty. It's getting worse and worse, this world, with uncertainty. And that's why gold will be a good long-term investment. I remember, 1250 gold. I don't know about 2000 gold. Hopefully 2000 gold, but then I do wonder where the world will be if you've got 2000 gold. So that's just a personal view on that. But 1800, 1900, great gold price, excellent gold price. You can make a lot of money. Most mining companies can make good money if they manage their costs. And I think as an investor, you should be looking at companies now going, okay, can they manage their costs? Are they nimble enough? Are they good enough to keep that margin?
Yeah, Yeah, okay. Now I want to give Empress a shout out here and give you the opportunity to tell shareholders what's going to make the price go up. What's Empress up to? What's the near-term activity? What are you guys doing?
Yeah, so Empress has been in the kind of orphan period at the moment. So we've invested our cash. We've got one producing asset at the moment, and we have two development assets that are just about to get into production. So the first one is Taweto, which is Ortho Mining, and I'm also chairman of that company. So I'm pleased to announce we've got our pre-production. It just started yesterday. So we're putting ore in the mill. So give us a bit of time, we'll be producing concentrate. And Empress has a silver stream from that asset. So we will be producing cash flow for Empress in the next short while. So a big tipping point for the company. So coming Empress from having one producing asset, we'll have another one. And then our third asset, which is about to come into production, is Manica in Mozambique. I was there 10 days ago, looking at the plant. It's new, it's shiny, it's just hopefully, fingers crossed, a couple of weeks away from being put into production. So Empress is on that lovely tipping point where it's going from one producing to three producing assets. And that means a lot of cash flow. So from coming from this year, we hope 6 million, hopefully 9 million next year, and then obviously growing from there in cash flow coming into the company.
Now, you mentioned the importance of yield and paying out dividends. Is it too early to have that conversation with Empress right now, or anything you can share in that regard?
Yeah, it is too early at the moment, but as you hear, I'm fairly passionate about companies returning some value to shareholders in the form of dividends. So too early now. As our portfolio grows, and we obviously will invest some of our cash back into new assets, but we will be putting aside some cash for dividends. It's important for this business.
All right. Look, David, thank you so much for coming on stage and chatting with me. I appreciate it.
This is Jay Martin.